at 10 o'clock. So we want to get started on time and get through everything in an hour and a half. Lynn is recording, so everyone's aware of that we're recording this meeting for note-taking purposes only. I want to welcome everybody. Just give you a little update. Lynn sent everyone the approved investment policy statement that was approved at the board meeting on October 25th, which changed some of our target allocations, et cetera. And we'll talk about, I'm sure, when we get more into our performance review about how that affects things currently with our funds. Also, just wanted to give everyone a heads up on December 6th. I'll be going in front of the Board of Ed during the work session. So at 3 o'clock, I'm sorry, on that afternoon. And I'm going to be going over the actuarial study, as well as what we call our contribution study. So that's a study we do that says how much should we be putting into OPEB every year to hit our certain targets. So we're going to be discussing that with them on December 6th. So I anticipate that. Normally work session, I think we've got like 15 minutes or so scheduled for that. So that will probably be fairly close to the beginning of the meeting. So if anyone wants to tune in there. Once those documents are ready and being posted on board docs, I am going to have Lynn send it to everybody in the committee also so that you have copies of everything if you really want to geek out and read an actuarial study and all that fun stuff. All righty. So that's all the housekeeping items. I'm going to move on to the approval of the August 18th meeting minutes.
I move to approve the August 18th meeting minutes.
Thank you, Derek. A motion, a second?
I'll second.
Okay, is that Renee?
Mm-hmm.
Very nice, thank you. Okay, we got a first and a second. Any discussion on that? Okay, all those in favor say aye.
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 Any opposed? Any opposed? Okay, it passes. All right, I'm going to turn this over to Tanya and Christian from Siegel Marco, and they are going to go over our investment performance as of September 30th, and they'll give us an update as of just a couple of days ago. I think on the 15th was their update. So they're going to do that. And then after that, we're going to hear from some representatives from Hamilton Lane Private Credit, and they're going to talk to us about this new asset class and what we may want to do in the future with that. So Christian, I'm going to turn it over to you.
Thank you, Leslie, and good morning, everybody. I'm just trying to get this presentation on the screen, so just bear with me 1 second. Is that coming in clear for everybody?
Yes, we can see it.
Okay, good. So as Leslie mentioned, we do have a bit of a time constraint, so we'll be a bit briefer than usual in terms of the market overview. Tanya is going to take you through the third quarter performance and then the market value update we have through mid-month November. And then we'll get Hamilton Lane to join the meeting and talk about their private credit fund. So in terms of the market, it's been very much a sort of seesaw experience in terms of what we've seen in equities and the bond market as well. You can see that reflected at the bottom of the page here. The S&P 500 representing U.S. large caps down close to 5%. This was again at the end of the third quarter. So that was for the month of September. Proved to be a negative quarter overall, and yet the year-to-date return was still quite positive of about 13%. Of course, coming off a very weak 2022. But in terms of sort of what's been driving the market, it's still been very much a focus on the Federal Reserve and their effort to battle inflation. You can see on the right side of the page, if you look at the various Bloomberg U.S. Indices, those are representing different sectors within the U.S. bond market. And for this month of September, they were pretty sharply negative, down in the neighborhood of 2 to 3%, which for bonds we know is quite volatile. And if you look, in fact, at the Bloomberg U.S. aggregate representing the core fixed income market overall, down about 1% year to date. So we had seen earlier in the year a pretty good start to the year for bonds, sort of meandered along for most of the year. And then in recent few months, as interest rates have continued to propel higher, we've actually seen bond returns turn negative. We've got a number of pages here. I think the one that I really want to hit, and this sort of ties back to the education session that we had fairly recently, was the yield curve. And you can see on the top right here, what we're doing is we're showing you where yields are across the Treasury curve at various points in time. So for the end of the first quarter is this brown line. The end of the second quarter, midway through the year, is this yellow line. And then the green line is the most recent quarter end. And so we know as the Federal Reserve has continued to hike rates, they did that 7 times last year, another 4 times this year. So 11 rate hikes in total in a very short period of time. Obviously, this very short end of the curve has been driven higher by that policy. And that isn't terribly surprising. I think what has been unusual in this environment is that as you move further out the curve, you see that yields have dropped. So in other words, historically, if you buy a longer term Treasury bond, you tend to be compensated more for taking that maturity risk. In this environment where rates have been pushed up so dramatically in such a short amount of time, we've actually seen an inversion of the curve. Where intermediate and longer term bond yields are actually lower than short term yields. And in the third quarter, you actually saw the intermediate and longer part of the curve start to move up. So still inverted, but much less so than it had been. And that was a reflection of the market sort of buying into what the Fed was telling it, which was that rates, although the short term rate may not go much higher, currently well north of 5%, that higher rates were probably going to be in place for a longer period of time than most people expected. When the intermediate and longer term part of the bond curve start moving higher like this, you tend to see a pretty negative effect in equity markets, and that's exactly what we saw in the third quarter. And so we'll have to see where things go from here. I will note that going beyond the third quarter, we actually saw quite a rally in these intermediate and longer term rates. And that really had to do with sort of a reversal in sentiment again, where the whole narrative of the Fed being in higher rate mode for longer transitioned to, well, how soon is the Fed going to start cutting rates? Because if you look at the jobs data and other economic data, it's actually starting to weaken, which is what the Fed is ultimately intended to happen. So it's very much, as I mentioned earlier, a seesaw sort of impact. I think this is a very interesting dynamic that's playing out. But as a result, the good news is we've seen quite a rally in the last month, this month of November. And you'll see that in just a minute when Tanya shows you the market value update through the middle of November. So again, a lot of sort of back and forth in terms of trying to read the Fed, trying to anticipate where interest rates are going to go. But overall, it's been a positive year for the equity market, and bonds with the most recent rally that we've seen are now back in positive territory as well. Before we move forward, any questions generally on the market environment? I know that was brief. Okay. Tanya, you want to pick it up with the report?
Sure. Great. Good morning, everyone. So just a kind of summary highlight here, you can see assets were at 160 million as of the end of the quarter, down about 6 million from June 30th. That was investment losses of 6.3 million. There were no cash flows in or out during the quarter. And you can see the return here down about 3.8%, underperforming the benchmark, which was down 3.3. The majority of that underperformance was because of the international equity manager, and we'll look at those numbers in a minute. And you can see the most recent fiscal year that ended in June of 23, the fund was at 13.1%. So this is our asset allocation as of the end of September. When we look at the November numbers, we'll actually make a recommendation on rebalancing based on the new updated investment policy statement that was recently approved. So as of the end of the quarter, slightly overweight equity, slightly underweight fixed income. And again, these were the kind of, we'll call them now old targets, and we will update these in our report next quarter and moving forward. Cash flow during the quarter, you can see, as I mentioned, down about $6 million on a one-year basis. If you look out a few columns over to the right, you can see the plan has grown over $20 million with about $1 million in positive cash flow as well. So as I mentioned, performance here, the plan was down 3.8 versus 3.3 for the quarter. You can see our U.S. equity portfolio is all invested in that Fidelity Total Market Index. So we combined what had been your large cap and small mid cap index funds earlier this year into one kind of all cap portfolio. So that's in line with the benchmark, down 3.3%. The international equity manager, it was American Fund Zero Pacific Growth, and they were down 6.3 versus the international index down 3.8. So that difference there is really, that spread is kind of the reason, again, for the plan as a whole underperforming the policy benchmark. And the reason for their underperformance primarily is given their sort of growth tilt, especially in the international equity markets this quarter, value stocks significantly outperformed growth. And so that their slight style bias there impacted performance on a relative basis. Your two fixed income portfolios are with Dodge and Cox in the core space and Western Asset as a core plus manager. A little bit of a rough quarter on a relative basis for Western, but longer term, you don't really see the history here, but if we look at calendar years, they've generally added value, and we still think it's a good space to try to add a little bit of premium over the core benchmark. Dodge and Cox as well has also been kind of a strong performer versus the aggregate over time. And then just a small portion in cash there at the end. And cash is earning about nearly 4% per year. Any questions specifically on the manager performance? Okay.
I'm going to pull up the November update now.
Great. All right. So our recommendation is based on the new asset allocation mix that has been approved, which includes a target of 32.5% to fixed income. So based on the numbers here, as of the end of, or as actually most recent, we are overweight that target, and we're at 56% in U.S. equity, which is actually kind of over the allowable upper range of 55%. And so we're recommending rebalancing $5 million from equity to Dodge and Cox as the core fixed income manager, and that will lower the equity allocation to 53%. And your fixed income that's currently at a total of about 29% will increase closer to that new target of 32.5. So again, that's our recommendation is to move that $5 million from equity to fixed income. And I believe that would be open to the committee for discussion and potential motion.
And I'll just add that, longer term in terms of the new policy that's been adopted, obviously private credit, which we're going to talk about today, that is a component of the longer term policy. We've also introduced the possibility of investing in a multi-asset class strategy as well. So we're aware that those are going to take time to fund and bring those allocations to target. And so that's the reason we're not recommending bringing the equity target all the way down to the new lower target and keeping it slightly above that. But longer term, the idea is to continue to bring down the equity. And as we saw in the modeling exercise we went through a few meetings ago, doing so without a material reduction in the projected returns, just given the fact that additional asset classes like private credit and multi-asset should generate nice returns as well. So hopefully that additional context is helpful.
Thank you. So the recommendation from our consultants is to move $5 million from our equity portion of our portfolio over to Dodge and Cox, our fixed income. Do I have a motion on that? Oh, Missy? Well, let me get a motion in a second, if you don't mind, and then we can have a discussion.
That's what I was going to move.
Oh, perfect. Thank you. All right. So I've got a motion from Missy. Do
I
have
second.
a second? And who was that? I'm sorry. Brian?
Derek.
Oh, Derek. Okay, Derek, thank you very much. So now we have a discussion. In the past, a lot of times when we've had deposits, we've been able to rebalance with our deposits. And since we haven't had a deposit in quite some time now, and we've changed our investment policy statement on top of that, that's the reason we need to rebalance at this point in time with our portfolio. Does anyone have any questions on that? All righty. Well, if there's no questions, I'll take a vote. All those in favor say aye.
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 Anybody opposed? And any abstentions by any chance? Okay, well, that's unanimous. Thank you very much. And so we'll have that, that'll be taken care of probably, I doubt it'll get executed today. It'll probably be beginning of next week. We'll do that before the Thanksgiving break. Okay, thank you.
Great. Tanya, anything else to mention in terms of the portfolio review?
That was it.
Okay, great. So the next agenda item, and obviously the big one for this meeting, is the presentation from Hamilton Lane. They are generally a private markets manager. They have a very large footprint in private equity. This offering that they're going to talk about is private credit oriented. So there is a pretty significant distinction. And I know you spent time with Tanya and Joey sort of talking through some of those differences and generally, how we think about private credit and the opportunity here. Just to sort of tee up Hamilton Lane specifically in this strategy, we think that this is a good fit here. It is a bit of a unique structure in that Hamilton Lane is coming to market roughly every year with a new iteration of this strategy. So this is the 8th fund that they've raised. There is a pretty tight window in terms of meeting the deadline to get into this fund, and that's absolutely okay from our perspective. That it looks like you probably won't make the last sort of opening for this particular iteration, but they're going to be back in market in the spring of next year, probably in March, with Fund 9. And there's not really a dramatic change from fund over fund in terms of the way they're managing the portfolio. It will adapt based on the current environment and the opportunities they see. But the good news is it's a relatively short fund life. And so if you think about the OPEB sort of unique cash flow situation, in that there's really no cash coming out of the plan right now, but there could be down the road. Pretty much at any point in time, you could start and stop committing to these annual fund series. So if there is a substantial need for money out of the fund down the road, because this isn't a liquid asset class, you can essentially stop committing to the funds. So we think that's a very attractive sort of element of their strategy and the way they structure their vehicles. We've asked them to, after they do a pretty standard introduction to the firm, to do a quick refresher on private credit, which hopefully is helpful for everybody. Talk about their strategy specifically within the realm of private credit. We want them to leave time for Q&A. And so I think those are sort of the key points. And maybe if we have a few minutes when they're done, we can talk about, how we think about sizing and the commitment amount that would make sense for the first commitment if the plan decides to move forward. So with that, maybe we'll just pause, see if there are any questions, and then we can let Hamilton Lane know to join the meeting.
Okay, any questions or thoughts before we hear from Hamilton Lane?
Okay.
All right.
I just shot them a note, so they should be joining momentarily.
Yeah, just check their members, and I saw, they're not here yet. Okay. And I think the timing will probably be good if the committee today educates themselves and feels comfortable. When you have your meeting in February, that would be a good time to make a decision if you want to make a deposit. And then once their next fund opens in the springtime, you'll be ready and poised to take that action.
Looks like Matt has joined.
Good morning, everyone. Hi, Christian. Hi, Tanya.
Good morning.
Good morning.
Welcome aboard, Matt.
Oh, thank you.
Good morning, everyone.
Good morning.
Matt, I'm gonna allow you to introduce yourself and your team, and then you can start your presentation.
I think we're waiting on two more. If you don't mind, just give us 1 second to get in here.
Not a problem.
Thank you very much for the time today. I think I see Nayef join, and I don't know if I see Tim.
Can you see me, Matt?
I do see you. There you go.
Okay, if I take us out, is that all right?
Real quick, Leslie, should we share the presentation, or do you guys all have that in front of you? Tanya, Leslie?
Most people probably have it, but sharing would also be beneficial for those that did not print it out.
Perfect.
How do we share on Google Meet? Is there a? I've got the presentation up, but
It's down present now at the bottom there, Tim.
yeah.
It's the little box with the arrow.
Looks
in
like
it.
a screen with an arrow pointed up.
Yep.
Okay. Present now. Got it. Okay. How's that? Can you see that?
It's going in.
Yep,
There
now
we
we
go.
can see it.
Okay. Let me see if I can manipulate it so we can.
Tim, why don't you kick it off?
Super. Super. Let me just see if I can get the pages. Make sure I get the pages correct here. That you can see that nose move. Okay, great. Okay, great. So yes, thank you. Thanks so much. Thanks, Matt. Thanks so much to the board. Thank you so much, of course, to Siegel Advisors, Christian and Tanya. My name is Tim Darcy. I work as a managing director in the client solutions area at Hamilton Lane. Hamilton Lane is a global asset management firm focused primarily on private markets investing. You'll see three of my colleagues on here today as well. Matt Herzog, who spoke at the beginning, works very closely with Siegel Advisors and our relationship with that firm. Rob DiOrio, who has responsibility primarily for the product we're going to talk about today, and Nayev Perry. Nayev is the global head of credit investing at Hamilton Lane, and we're here to talk about a very specific product called Hamilton Lane Strategic Opportunities Fund 8. It is our flagship private credit product. We will talk about the product details during the time that you gave us, but just as a reset, I'm on page 2. I think that's the page that's up on the screen. This fund is going to do a few different things that we'll go over. It's going to leverage the platform here at Hamilton Lane, which is a critical part of delivering a portfolio like this. We're going to target short duration investments and yield. And we're going to do it with an investment strategy that's very flexible and that goes over and works across all credit structures. We do know and can appreciate that this is not the only thing you're doing today. We know you have a hard stop this morning. So we're going to be very timely in our comments. Happy to answer any questions that you have during the time that we're speaking, or happy to leave them at the end as well. But as we go through the strategy with the folks from Hamilton Lane on the presentation today, it is important, I think, to take a step back and go over more about who we are, get a better understanding of Hamilton Lane, and why we are uniquely qualified to deliver on a portfolio and strategy like the one we're going to talk about today. I'm hoping Matt can take us out and do that before entering into the strategy. Is that all right, Matt?
Yeah, sounds good, Tim. Let's move over to page 4, if you don't mind, to start us off. So, as Tim mentioned, we are a global private markets focused asset manager. We spend 100% of our time on private markets investing. As you can see on the slide here, we have about 818 billion in assets under management and supervision, and we're putting out about 40 billion each year in new investments. That's across our 1,450 clients and through our 23 global offices, just to kind of give a level set of where we think we are in the market and how we can deliver good returns to our clients through this scale. On the right side of this page, we always put this in our book. Our mission with our clients here is to enrich lives and safeguard futures. We understand who the actual beneficiaries of these plans are, and we want to help the school teacher, the firefighter, have secure retirement. So we really take that to heart. You'll see that as you work with Hamilton Lane, that we know that our first job is to make sure that your capital is safe and deliver you returns so that you can get to enjoy the money that you're investing. maybe we can move to page 5. And so 5 and 6 is really going to show a little bit more of that scale in a different granular way. You see the funnel on the left side here. And what I mean by that is that's showing the landscape of investments that we see each year. And as Tim had mentioned, we're not just a private credit shop. We are a private market shop. So we cover private equity, private credit, secondaries, real estate infrastructure. And because we cover the entire private markets, we're able to see the entire opportunity set each year. So that's what you see here on the left side of the page. 1,100 primary fund investments. Traditionally, I'm going to let Naif go through how private credit works. Traditionally, in private markets, much of that investing is done through fund investing. So that's primary funds, secondary investments in funds, and that 980 is that direct investments. That's what we're talking about here with our StratOps fund. And the benefits of this scale are highlighted at the bottom. Moving on to slide 6 here, this is also showing the scale because we've developed, with all of that intelligence and information that we have through seeing the market, we're able to develop tools that help ourselves become better investors and our clients understand the market better. So you can kind of see the level of investments that we're tracking. Just the total fund commitment, 17.2 trillion in investments that we're tracking across everything. So I'll stop there. That is a very quick summary of Hamilton Lane and how we go through our investments and what we see each year, the breadth and scale. I'd like to pass it over to Naif and just do a private credit overview, start high level and drill down. I want to stop there and make sure we're on the right page. Leslie, if you just give me a nod, we're good.
Yes, we're on slide number 8.
Yeah, I think, Rob, you want to?
Matt, if we can,
24.
can we jump to slide 24? I
There
think
it
it
is.
is.
Yep.
Wonderful. While we're changing pages here, just wanted to say thank you again. Echo some of the opening remarks by my partner Tim, and just wanted to thank you all in advance for your time. I thought what I'd do is just keep the conversation very simple and just cover 3 quick things here. First is, what is private credit? What does it mean when we talk about private credit? What are we investing in? Secondly, what does this market opportunity look like? And then lastly, why are investors drawn to this asset class when you have so many other choices in investing? And the spoiler alert there is, it is an asset class that has performed very consistently over long periods of time. Said differently, it's very hard to lose money in this asset class. So with that, I think the best way, rather than lose everybody in corporate jargon and financial jargon, I think the best way to understand private credit is to use a house analogy. And when you think of a house has a mortgage and it has homeowners equity that sits below that. And typically you have, a single mortgage, but sometimes you may have a first mortgage and a second mortgage in front of the cash that you put into the house. And in that structure, the first mortgage typically charges a lower interest rate because it sits first in what's called the capital structure. So it's lower risk. And then the second mortgage, which sits behind the first mortgage, might charge you a little bit more because they're in a slightly riskier position. And so in a situation where that house sells, the first mortgage is typically any dollars that come from that sale go first to repay that first mortgage. Then it goes to repay the second mortgage, and whatever's left over goes to the home buyer. And so companies are no different from houses. And we, Hamilton Lane, as a lender, are the mortgage provider. And the private equity firms that we back are really the homeowners. And they're buying these companies, and we are what's called capitalizing these companies with a mortgage. And so, I think the science of private credit is figuring out where the best risk-adjusted opportunities are, whether it's a first mortgage or second mortgage, based on factors such as, what does the company profile look like? How does it generate income? Who are the owners behind these companies? And just what does the macro backdrop look like? Are we headed for recession in a sector where that might be more cyclical? So we factor all those things, and we utilize, a team of very experienced professionals across our platform who have been doing this their entire careers to evaluate and make decisions on where we play in that what's called a capital structure. And so to tie that to what you're looking at on the screen, on the left-hand side, we call this performing private credit. And all those blue boxes from dark blue down to orange and sort of that middle column are really the menu of different securities that sit in what's called a capital structure of a company. So think of the blue boxes as different types of mortgages, and the orange box is the homeowner's equity. And typically in a company, when we make an investment, you don't see all those levels of quote unquote mortgages. But the idea here is just to give you a sense for the different flavors. And as you see, we've put some percentages to the right of each of those boxes. That gives you a sense for, depending on which of those boxes you choose, that is the expected yield or return for taking that risk in that type of box. I will pause and see if there are any questions.
No, I think that's pretty self-explanatory, or at least from Tanya and Christian gave us a little tutorial last meeting, so hopefully we've got a little bit of knowledge to build upon.
Very good. Well, don't hesitate. No question is too basic. It's a simple concept that becomes a complex asset class. If maybe we move ahead, I think we'll pivot to kind of point number 2, which is, what does the market opportunity look like? I know this page is a little bit of an eye test, so let me just kind of navigate towards the kind of the punchline here. Maybe we can go forward one slide. So private credit, when we talk about private credit, if you are a private equity firm that is going to buy a company and you need capital to buy that company, you're typically getting that capital from one of two sources. You're either getting it from a bank or you're getting it from the private markets. And what we've seen over the course of the last 20 or so years is that the bank's market share has diminished considerably over that time period. So 20 years ago, the banks provided 80% of the loans for private, for in terms of credit. Today, they're less than 15%. And private credit has stepped in to fill the void. And what's been driving that change is a combination of regulatory and other factors that have allowed private credit to become a more relevant source of capital in today's environment. And so as that asset class has grown, we continue to believe, and I think the proof is in the data and the pudding, but private credit is going to continue to see increased market share. So those trends we don't expect to reverse. And as you look at what the opportunity set is in private credit, we think there's a huge opportunity, and nowhere is that more evidence than in that bottom chart with the orange line. And what we're showing you here is all the dark blue bars. So if you go to the very far right of that chart where you see Q1 23, through the first quarter of this year, that dark blue bar is the total amount of credit capital that's been raised in the private markets. And then that orange line is the amount of buyout dry powder. So these private equity firms that raise money, that's the amount of buyout dry powder that's been raised. And what we're showing you here is there is almost a $750 billion gap in the availability of capital. So simply said, there is not enough supply of private credit capital to meet the demand. This is one of the things that gets us very excited about the asset class. If we go forward, I'll just kind of hit the last point I wanted to make, which is, why are investors drawn to private credit? And I think this is a beautiful slide. It is very kind of, I think, succinctly, it just makes the point. And what we're showing you here is the dark blue bars from 2000 to 2021 are the average performance of the entirety of private credit as an asset class. So all funds of that vintage versus the orange dots, which are the public market equivalent that we compare private credit to. And what you see here is that on the average, not only has private credit had positive performance every single year for the last 21 years, 22 years, but it has outperformed its alternative, its public markets alternative, in 21 out of the last 22 years. And so it is very consistent. And then those dotted lines, which you see on top of the stack bars, are the top half performance within private credit. So when you start to pick better managers in that asset class, that's where you really start to see meaningful outperformance against benchmark. It is a very stable asset class. If we go forward one more slide, what we're showing you here is dispersion of returns across different private market strategies. So from left to right, we're showing you buyout, venture, credit, and real estate. And then over what is, I think this is a 25-year period, but I need to go back and double check. We're showing you kind of what is the low and high return or dispersion of returns. And then the orange is the average return for the strategy. And we're showing you in the worst markets and in the best markets how these strategies perform. And the punchline here is that private credit, those bars are very narrow, which means it has a very narrow, tight dispersion of returns, which means it's very predictable. So in bad markets and in good markets, it does really well and it's very consistent. I think this is one of the big drivers that is pushing investors to move into this asset class and also to rebalance away from areas like fixed income. I will pause again and see if there are any questions. Otherwise, we can zoom back out and start talking about the credit platform. Okay, I think Leslie gave me the thumbs up. We'll keep going. So look, I'll keep this brief as well. Please stop me if you have questions, but we'll give you just a quick flavor for our credit platform. Think of this as the engine behind the product being our Strategic Opportunities Fund. And then Rob will take us through what our Strategic Opportunities Fund series is all about. And just high level, we have been investing in private credit for about 22 years. So it is a very established strategy at Hamilton Lane. Of the $820 billion that you heard Matt talk about, private credit or credit in general is about $51 billion of capital. So it is a very big part of the DNA of Hamilton Lane and arguably one of the faster growing areas of our business, which is getting a tremendous amount of resource and attention from the firm. As you look at our performance over everything we've realized since inception across the strategy, we have made about 160 investments, of which half have been exited successfully. Of all those exited investments, we've generated in the dark blue bars over a 13% IRR on those investments. And on a net basis, meaning after any fees and expenses, those investments have generated over an 11% net return to investors. And this is what we call unlevered, meaning there's no incremental risk. We're not putting leverage in the funds. That translates to about 700 to 1,000 basis points of outperformance, depending on how you're looking at that. And just to put that in context, we would typically guide investors for a credit strategy to want to deliver 150 to 200 basis points of outperformance. So for us to be at multiples of that, I think is something we're very proud of as a platform. Matt talked about the importance of scale and data and information advantages. We utilize all of that because these are private markets. They're not public. So you don't go on the company's website, pull their public financials, and then understand how these companies have performed over long periods of time. This information doesn't exist in the market. We have it, others want it. Said differently, sometimes we have more information on the companies that we're underwriting because they were owned by another private equity firm that we manage and track in our database. So we have more information than the folks that are bringing us the deals sometimes. And that gives us a huge underwriting advantage. It is very powerful for us to know how these companies behave. It allows us to be focused on the right risks. And it allows us to do things like reference call these assets with prior owners to make sure we're focused on the right key areas of diligence as we're evaluating these companies. Very simply, we follow a very clear formula for selecting companies. And I think that has led to the consistency of performance. When we make an investment, and this is really kind of driving, I think, some of the performance you see here. Number one, we want to invest in companies that are backed by leading private equity owners in their areas of expertise. And again, we utilize the data and information to make sure that we have the right owners behind those companies. Number two is we want to invest in market leading businesses. And what that means is these companies that we're investing in have a number one or number two position in their markets. They have very strong customer supplier diversity, very predictable earnings, They have scale and they're defensible businesses. That's really important to us. Number 3 is we want to invest in recession resilient sectors. So we don't do areas like energy, which you tend to be very cyclical. Instead, we focus on sectors that perform through good and bad times, and their demand drivers are very consistent. Think about areas like healthcare, where demand drivers don't change whether we're in a recession or we're in a good period of time. And then finally, we want to invest in the most conservative capital structures, meaning we want to put very low levels of debt in these companies with a lot of cash equity from these owners behind us. Because they don't see a dollar of capital till we see our last dollar. So that conservatism is really embedded in our selection process. Maybe we can move forward, Rob. Deal flow. I think the only thing to say here is this is the lifeblood of the platform. We are one of the largest, if not the largest investor in the private markets. And the importance of that is it allows us to see a lot and do a little. And this year, we're on track to see somewhere, I think this number is old. I just ran the numbers last week, but we're on track to see between 12 and $13 billion of deal flow this year. That's over $1 billion a month. And the importance of that is when you see a lot, you can be very selective. You're not forced to deploy capital into unnatural things. And that volume allows you to say no a lot because you know the next deal is coming. And so that allows us to maintain our investment discipline. And that is incredibly important. And the only thing I would say here is we are in a market backdrop where M&A volume is down materially from 2021, which is a record year for the world. And in a market where deal volume is down, our deal volume is up. And our scale is allowing us to be able to see opportunities where others are not. And again, that's really important for our limited partners and for the success of the platform. Rob, maybe just go to the team page and I'll hand it over to you. I'll end here, but this is really the brain trust of the team. And I think it starts with our investment committee up at the top. What you see is sort of 9 of among the senior most members from across the firm. I think what's important about this group is it is a group of members that have been making decisions together over long periods of time and through multiple market cycles. And that knowledge and that experience really important in our selection process. As you look at the team below that, this is sort of the credit team. And I think what is important to call out on the credit team is you look at the backgrounds of the individuals that make up the credit team. We have pulled, and you see some of the icons on the right, but we have basically built a team over the last decade plus of really experienced professionals from some of the best institutions, whether they're private markets firms like Ares that you might recognize, or leading leverage finance banking institutions like GE Capital. And we've been able to pull together best in breed and create a very diverse risk management culture where we can take best in breed. And I think that has enabled a very strong credit culture within the firm and a very cohesive team. And lastly, I just said we've never lost a senior member of the team. So it is a very, I think, sticky group, very aligned, that's been investing together for quite some time now. Any questions on the platform before I hand it to Rob to talk about the fund? Okay, Rob, the floor is yours.
Cool. Tim, if we go to slide 14, please. All right, so the team has covered a number of the key aspects of the strategy. What I'll do is take a minute here and just summarize what our strategic opportunities funds look like and what they're looking to do in this market environment. So StratOps is our flagship direct credit fund. We launched the series back in 2015, and it's an annual series, so we are raising a new vintage every year, currently fundraising for our 8th vintage in the series. These funds are designed as short duration vehicles with a focus on downside protection and cash yield. We're investing in loans in high-performing middle market to upper middle market companies. These companies, as Naif was pointing out earlier, are looking to grow their businesses using debt capital to finance them. So we are making loans in those most senior areas of the capital structure, those first lien, second lien term loans that you saw on that chart earlier. Those first lien, second lien term loans will make up 70 to 80% of any given portfolio. And then we'll round out the funds, moving a little bit more junior in the capital structure, but importantly, still credit-like securities that have contractual maturities and interest rates, but the opportunity for a bit more yield. From a performance standpoint, we're targeting high single, low double-digit net performance. So in a zero rate environment, like we had seen up until recently, we'd expect to be on the lower end of that range. But in today's market environment, where interest rates are up over 5%, we expect to be on the upper end of that range. And as you'll see with the fund we're currently deploying, Fund 7, our IRR is more in a 12-13% target range. The other key component here is the cash pay. So these underlying loans produce monthly or quarterly interest that we receive, and we in turn distribute right back to our investors to make sure there's a consistent distribution stream going back. And then this fund has a really unique structure. So a traditional private credit fund in the market is going to have around a 10-year fund term. We are focused on short duration here, so it's just a 5-year fund term. We're really looking to invest capital within a 1-year investment period and then quickly get that back to our investors. And then the last thing I'd highlight here is this is an incredibly fee-friendly structure for our investors. We charge 1% on net invested capital. Siegel Marco, because of our longstanding relationship, will have a 10 basis point discount for this fund series, so it'll be 90 basis points on net invested capital. And on top of that, that net invested piece is really important because this is such a short duration vehicle where we are exiting deals quickly. That fee basis comes down really quickly. So the all-in fee is going to be much lower than that 90 basis point number. I'll pause there before diving into any more detail. Any questions on the overall fund strategy? Good. Cool. Tim, if we can move forward one slide. So Naif hit on some of the key reasons why we're excited about this market opportunity. I'll just quickly highlight those two charts at the bottom to put that in perspective in relation to our funds. So we are investing in predominantly floating rate securities, which means that as interest rates move up, in our case, as the SOFR rate moves up, our cash yield moves up as well. So if we rewind the clock back to Q1 2022, SOFR was flat. So at that point in time, we were generating around 8% cash yield. Fast forward to today, SOFR is up over 5% and our cash yield is up over 12%. So without taking on any additional risk, we're generating an additional 4% interest that we are distributing right back out to our investors, which makes this a really unique opportunity for private credit. Next slide, please. So this slide here gives a quick snapshot of StratOps as a platform. And I'm going to focus on the right-hand side of the page. So in the top right there, those average deal level stats represent an average borrower. So what does a company look like that we are lending to? That average EBITDA or average earnings are over 200 million, which tells us that these are large, well-established companies that are market leaders in their respective industries. And the reason we like to lean into those businesses is because, one, they're typically well diversified. Two, they generally have a strong recurring revenue stream. And most importantly, they are best equipped to navigate any type of market downturn in comparison to smaller companies. Just as important here is that 52% LTV or loan to value. That is where we're coming into the capital structure, meaning we have 48% equity sitting beneath us here. So before our first dollar is at risk, that 48% equity would need to be impaired. So zooming back out between that strong EBITDA number and the conservative LTV, it highlights our focus on downside protection. The last two stats I'd quickly hit here are the bottom right, that increase in revenue and EBITDA. Our companies are performing well. Revenue and EBITDA have both increased significantly since we've made our investments. As we think about any potential downturn in the market, the key lever that we have is the strength of our deal flow and the opportunity to be highly selective in our investment choices. And these numbers tell us that our underlying portfolio is performing well and is in a healthy position today. All right, if we go to the next slide. I'll quickly touch on fund performance. Naif already highlighted that top right chart there, which is our realized track record. The bottom half of the page is our fund by fund performance. So we had our first fund launch in 2015. That's the bar on the far left. That fund is fully exited today and ultimately generated a 14% gross IRR, 10.6% net IRR. I think the key takeaway on this page is all of our other funds are trending in that same general direction. They are all in line to hit those high single, low double digit performance targets. And importantly, they are outperforming those public market equivalents by 300 to 500 basis points, depending on the fund. I'll quickly highlight the fund on the far right there. That's Fund 7. That's the fund that we are currently constructing. We're going to wrap up portfolio construction over the next couple of weeks and then begin Fund 8. But Fund 7 is a great example of why we're excited about the current opportunity set. This fund is wrapping up portfolio construction and has already generated near 13% gross and net performance, taking advantage of the current market opportunity. Fund 8, because we expect it to be deployed in a similar market environment next year, we plan for the portfolio construction and ideally the performance to have a similar look and feel to what you see here with Fund 7.
Rob, maybe just for the benefit of the group, and you talked about loss mitigation. In the 25 or so average holdings in each fund, historically, how many of those holdings have actually lost money, have turned negative?
Yeah, it's very few and far in between in the portfolio. We have just 3 or 4 investments that we're closely monitoring, but we actually only have 1 realized loss to date across the platform. The company for...
And that's almost 200 investments. Sorry to jump in, Rob,
Yeah.
but we're talking about a big body of work. To have 1 impairment in almost 200 investments is very unnatural for a credit fund.
Thank you.
Sure. Any other questions on performance or otherwise before we jump ahead? All right. So just a couple other slides we wanted to hit on here. This one here hits on 2 key tenets of the portfolio. 1 is the short duration nature, and 2 is the ability to generate meaningful liquidity. So since inception, we've seen over $2 billion in distributions, and an average investment in our portfolio has just a 2.5-year average hold. So if we think about the short duration guidelines we have, when we're diligencing these deals, we are underwriting them to a hold of 2 to 4 years. We want to exit before that 5-year fund term, and our exited deals right now have that average hold of less than 3 years, so we're doing just that. And importantly, what that means for investors is the right-hand side of this page. The green bars represent our distribution profile. The blue bars represent private credit funds in market of the same vintage year. We are out distributing other private credit funds because of our focus on short duration. When we receive interest payments or when we exit a transaction, we take all of those proceeds and distribute them right back to our investors. Our investors are going to see 1 to 2 distributions per quarter over the life of the fund, which is unique in this asset class. And you can see the dispersion between us and our peers in the market. Jump ahead to the next slide, Tim. So I know this slide is a bit of an eyesore. There's a lot going on here. I'm going to break it down by the quadrants to just briefly hit on some of the key components of our portfolios. So in the top left there, the breakdown by strategy, the key story here is consistency. We are investing 70 to 80% of every fund in direct credit investments. Where you see the flexibility in this strategy is that top right chart, the breakdown by security. So while we're hitting that 70, 80% direct credit, whether we are in the first lien or second lien, that first mortgage or second mortgage, to use the analogy that NIAF used earlier, can change depending on the market environment to ensure we're delivering the best risk-adjusted returns. So a good example of that is Fund 7, the one we're currently deploying that I had just mentioned. In today's market environment, because of the rising rates and us benefiting from them, we're able to lean more senior in the capital structure without sacrificing yield. If we think about what the pricing on a deal looks like today, our pricing has a base rate, which is the interest rate, plus a spread. So previously, when base rates were at 0, we were really just benefiting from the spread. Today, we're adding a 5.5% interest rate to that spread. So we're able to lean more heavily into those senior positions while still generating a 12% yield. On the bottom half of this page, we touched on EBITDA a bit, the earnings profile. We're leaning into those larger, more stable businesses. So over 80% of the portfolio is going to have earnings of at least 50 million. And then on the industry breakdown on the bottom right there, we're going to be highly diversified across all of our funds, but we are leaning into defensive, service-oriented type sectors. So you're always going to see a healthy allocation to healthcare, software and technology, industrials. You're not going to see us in more cyclical businesses like energy or brick and mortar retail. So with that, Tim, do you want to just jump to slide 22? And I'll quickly hit on the terms here, and then we can leave the rest of the time for questions, or we can provide a case study, whatever would be most helpful for you guys. But a couple quick things to mention with the terms. We touched on the management fees and the 10 basis point discount already. To the extent you're interested, there is additional discounts available for investing in successive funds. So if you determine this was a product you like and you wanted to build some vintage year diversification and invest in funds 8 and 9 or 8, 9, and 10, there's an additional 3 or 5 basis point discount involved there. We, Hamilton Lane, want to be aligned with our investors, so we are committing 1% alongside our investors in each of these funds so that we have capital at stake as well. We have multiple fund structures available. So we have an onshore Delaware vehicle, an offshore vehicle, and a Luxembourg vehicle to make sure that you have the most tax efficient options for your portfolio. And then just a quick note on timing. We are wrapping up the fundraise for Fund 8 over the next month or so, at which point we'll begin deploying capital. We'll deploy that capital over a 1-year period, so throughout 2024, and we'll call capital from investors once or twice per quarter. And then really in year 2 is when distributions kick in, and we'll be issuing distributions once or twice per quarter throughout the rest of that fund term. But I'll pause there. We're happy to take any questions, provide a case study, whatever would be helpful for the group.
I think maybe just highlighting the incentive comp piece of your fee, the preferred return and the carried interest, and just quickly, how that works and what that means.
Sure. So on that piece, we have a 10% carried interest component and the 6% hurdle rate. So essentially, we need to hit that 6% hurdle before our carried interest kicks in. So as we think about our distribution profile, that distribution waterfall, we are going to have distributions back to investors until we hit that 6% hurdle rate. At that point in time, we'll be able to collect our carried interest component. And then once we hit our carried interest, it is split 90-10 between investors and us for the rest of the way. But the focus here really is to make sure that investors are hitting that hurdle rate and beyond within that 5-year fund term.
I think I just add to Rob's comment, at the risk of sounding too commercial. I think you'll find is we are building, what I would define as the mutual fund of private credit. So when you come into this fund, you're getting very broad diversity, not just by sector company, as Rob alluded to, but also by the private equity funds and credit funds that we typically are investing and partnering with in these transactions. So it is really a diversified vehicle. And when you think about the alternative of accessing this asset class, we think, and I know Siegel has a very good handle on this, but we think this is one of the most cost-effective ways to access the strategy, especially for an opportunistic vehicle. We typically see the fee load as much higher for other funds.
If there are no questions on the terms, I do think it would be helpful for the group to hear a few case studies. We've probably got, Leslie, maybe 10 more minutes.
Yeah, that would be perfect.
Yeah, maybe we can just go back to the case study page. It was the page before the terms page.
Yep.
Sorry, Nave, what page are you on?
Go to 21, please. Thank you, Tim.
21. Okay, sorry.
No worries. So I think what we've done here is we've just provided a kind of 4 examples of the types of investments you would typically find in our strategic opportunities funds. And what we've endeavored to do from left to right is provide, as you kind of reflect back on the different boxes in the capital structure, the different mortgage examples that I provided at the beginning of the conversation, from sort of top to bottom, we have provided 4 examples of some of those different quote unquote boxes, deals that would fall in those different boxes, just to give you context around why we've provided 4 different case studies here. And probably one of the ones that I would highlight that's on the newer end is the middle column, which is Vistage in the dark blue and kind of the middle left. But just by way of background, this is a company that is the world's largest CEO coaching organization to small and medium enterprises. And this business has a very predictable revenue model because these CEOs of these small businesses basically subscribe to this business on an annual basis. So it's a contractual subscription. So it produces very predictable recurring revenue. The company boasts a very diversified customer base. So they have well north today of 27,000 middle and lower middle market CEOs that make up their membership group. And what is important is this business is incredibly recession resilient. And the reason it is so recession resilient is these CEOs of these small businesses typically do not have the C-suite around them in terms of a chief financial officer, chief operating officer, and industry expertise from an experienced leadership team that they can lean on for decision making, particularly during periods of market volatility. And so what this membership offers them in terms of value add is if you are the CEO of a small either bottling company or a beverage company, for example, you are put into a cohort, and the kind of top of that cohort, these are tiny cohorts, but the top of that cohort for that relevant group might be the former CEO of Coca-Cola. And so you've got direct industry access to some of the world's leading thought leaders in that space that can help guide and mentor decision-making through that process. It is an incredibly valuable organization. In fact, we know some of the members as we were going through the due diligence process. So just kind of stepping back, we had invested in a second lien term loan here. As Rob alluded to, there is sort of a coupon plus a spread. So in this case, we invested in a deal that was priced at SOFR plus 825. 825 is what we call the spread, and SOFR is the variable rate. In today's environment, SOFR is close to 540 basis points. So this is a coupon right now that we're getting that is close to 14% before additional fees that we're getting on that particular security. I think what was unique about this transaction is it was purchased by a group that we know well called Gridiron Capital. They are a Connecticut-based general partner in the lower middle market, and the business sort of services angle is sort of squarely in their wheelhouse. We've backed this general partner over multiple funds, well over a decade, and we have a tremendous amount of familiarity with their capabilities. So we, in simple terms, knew that this was the right owner for this particular asset. In addition to that, when they had identified the asset for purchase, they had contracted a group called Intermediate Capital Group, or ICG, who's a private markets lender, to help finance that purchase of that business. And as they did that, they told ICG, we would like to bring in Hamilton Lane and prioritize room in the capital structure on relationship. And so we basically had a right of first offer on that loan. And it just so happens we are not only a large investor in ICG, but we have a tremendous relationship with them, have executed multiple deals with them. So it was sort of a very happy marriage, let's say, in terms of being able to come into that transaction and partner with somebody we had deep familiarity with, and also a very like-minded sort of lender and risk philosophy. And so we got unique access to the deal, which is one of the tenets of our platform. There were only kind of 2-3 lenders in that transaction. And then on the information advantages, this was a company that we were able to really leverage our database in terms of understanding how this business had performed previously, and really kind of understand Gridiron's DNA and confirm that they matched well to the asset. And I think that is sort of a key tenet when we make an investment, is the ability to not only look at the asset, but make sure it's got the right owner behind it. So I think a very good case study example of a business that had, conservative capital structure, leading sponsor in their area of expertise, a very conservative capital structure, There was a lot of cash equity in this transaction sitting below us, and it was a very recession resilient industry. Any questions on that?
Maybe one more.
Sure. Maybe I'll touch on Crash Champions. Clear Lake. This is a business that is a leading automobile collision repair business. They provide a full range of services, and kind of in short order, Clear Lake Capital is the group that owns this company. And the whole thesis for this business is to go out and buy smaller mom and pop auto collision repair shops across the country and make 1 + 1 = more than 2 by building these this broad network, and then really utilize the strength of their insurance relationships to drive business to those mom and pop collision repair services. And so the company has a leading market position. The deal was kind of squarely in Clear Lake's area of expertise. And we had an opportunity to step in alongside Oak Hill Capital Partners, who's a group that we know very well. We've transacted with them on multiple transactions, to basically provide a first lien loan. So think about it, the very top of that mortgage structure, first lien loan in a deal that was priced at SOFR plus 700. And again, going back to the spread comment that Rob made earlier, SOFR's at, again, 540 basis points today. Our average coupon right now is close to 12.5% that we're earning on that loan. Now, it didn't start at 12.5%. They expected to pay a lot less, but as interest rates went up and we are in a floating rate structure, which is the majority of what we do, the yield on that coupon has improved. We also got 2% upfront in the form of a closing fee. And so as you can imagine, when you're getting 12.5% and you get a 2% upfront fee, the IRR potential on a transaction like this before any fees on the back end of the transaction, if you get refinanced early, can be somewhere in the 13+% range to sit at the very top of the capital structure in a very good business. Company has a leading market position. That was really important to us. A very defensible business and a very diverse business, not only by location, but also by insurance carriers. I think ultimately, we were able to get comfort with the transaction. One, we got unique access to the deal. So through our relationship with both the lender, Oak Hill, as well as Clear Lake, the owner, we also had the ability to reference call this asset. We knew other owners of other similar assets in the space, and we were able to reference call the asset, make sure we were focused on the right risks. And ultimately, we were able to track ownership of this asset under Clear Lake's hold period. And so we had visibility in terms of how this asset was performing leading up to us coming into the deal. So it really kind of hit all the DNA traits of unique access and information advantages with all those 4 criteria: right owner, conservative capital structure, recession resilient sector, and then market leading business. Christian, anywhere else you want us to go?
I think I'm good on my end, but I'll defer to Leslie.
No, I think that's good. And I like the 2 examples. That gives us a more something we can put our arms around as to what we're talking about. What type of companies are we lending to, or you're lending to? I'm gonna turn it over to the committee himself. Does anyone have any questions?
Hey, Leslie, it's Brian. I just have 2 quick ones, and great presentation, because I had about 5 or 6 and you answered most of my questions. So 2 quick questions. And I'm in the car and I'm working off the phone, so you may have already gone over this and I just can't read the slides. But anyway, you talked about performance and things like that. But what I don't think I heard you say is like what level of non-accruals the different funds have. Like, are you guys experiencing an uptick in non-accruals in the current market?
That's a great question, Brian. Look, I think maybe call us good or call us lucky. I don't know. But I think we made the silly investment decision, over a decade ago, thinking that in the next couple of years, we were going to experience a recession. I think we've been wrong for the last 8 years. But what that did was, I think it put us in a mindset where, because we thought every deal that we were putting in the portfolio at some point was going to experience some stress, it caused us to really tighten our our profile. And if I'm being honest, I think investors in the past probably criticized us for not taking enough risk in some instances because we took a conservative posture. But I think when we roll forward to COVID, what it did was it put us in a very fortunate position that we had very few challenges in the portfolio as a result of the pandemic as a starting point. And so I think in a body of what was, probably 180 loans up until that point, I think we saw maybe 5 amendments leading up to that period, and 2 to 3 of them were COVID related. So we had very few issues. To give you a substantive example of one of the companies in the portfolio that requested an amendment, we had invested in a company called Jacent, which is a strategic merchandising business. That business, if you go into a grocery store aisle and you think about the chip clips that are on those aisles that they sell apple cutters and batteries, that is an incredibly profitable business because you'd be surprised at consumer behavior and how they grab those things as they're walking through a grocery store. Very stable company, conservative capital structure, all the things we talked about. And when we got to COVID, the grocery stores, because of shelter in place, shut down. And those impulse products were not available on some of the online channels. And so that business went through a 3-month disruption where their revenues collapsed pretty meaningfully because I don't know if you remember, but you'd have to wait in line with your mask at the grocery store and they'd only let a certain number of people in and you'd have to kind of walk one way in the aisle. You couldn't walk 2-way traffic. And so because of those dynamics, the lenders put more money into the business to help support it, which was a positive, a credit enhancement. And they came back to us and said, listen, because EBITDA is tighter for this period, we may be at risk of brushing up against our covenants. Can we get a little bit of operating room? And in exchange, we're putting in more money and you guys will get some incremental fees for that. We got comfortable and we were able to do that. So very few problems, thankfully, in the portfolio, but that's one example where we gave them some flexibility and we've seen the business kind of pop back. Another, if I roll forward now to a higher interest rate environment where you kind of see some of the headlines being, hey, are we headed for a higher default environment? The short answer is we have not had any issues in the portfolio. We did have one borrower come back, again, out of now 200. We did have one borrower come back it was an aviation related industry where they had some exposure to the Boeing 737 MAX platform. And I think everybody knows what happened with that. Boeing cut orders for a period of time and they've now resumed production of that aircraft. But that coupled with lower passenger volumes through COVID, the company needed to make some new investments for some new customers that they took on. And so as a kind of just in the spirit of partnership, they asked the lender group if a portion of their loan could go from pure cash to a portion of what's called PIK or paid in kind to help them preserve some cash flow as they're onboarding some new customers. We got comfortable because that business has over $1 billion of backlog, meaning these are aircraft that have already been purchased that they know they have to go out and build. We were pretty comfortable with that. And so that would be an example where we saw a higher interest rate environment maybe pinch that particular business.
So non-accruals aren't going up then, just to confirm?
Confirmed.
Okay. And then my last question, you kind of talked about the profile of the companies you invest in with revenue and you talked about LTV, but maybe I missed it, but I didn't hear debt to EBITDA. Like what would be an average or a weighted average debt to EBITDA for a fund?
Yeah. So for this series, our average debt to EBITDA is between 5 and 6 times. And keep in mind about 75% of this portfolio across now what are soon to be 8 funds have historically been kind of in unitranche second lien securities. So you're a little bit kind of in the middle of that capital structure. I think the other important thing to look at is loan to value. And when you look at the loan to value in our companies, our average loan to value, if we look at the average across everything from the junior most securities to the senior, our average loan to value is close to about 50%, which means that for every dollar that's invested in the company, there's 50 cents of cash equity from tier 1 sponsors at risk below us. They are very motivated to get those situations right, so they get their capital back. And of course, they don't see their capital till our investors see their capital first. We've really put a lot of focus on that as we've underwritten companies. And specific to that LTV, we recognize that LTV can be a point in time. We spend a lot of time in our analysis looking at the behavior of enterprise values over long periods for these companies to try and make sure that during periods of recession, that the value of the companies doesn't bleed inside the value of our debt. So said differently, there's still a lot of equity cushion, even in a recession scenario for our companies.
Got it. That's all for me. Thank you.
Yeah, thank you for the question.
Thanks, Brian. Any other questions? Okay, we're pushing up to our quit time here. Christian, next steps here.
I think we can excuse Hamilton Lane if there are no more questions for them and just wrap up.
No, as for, speaking for the committee, thank you very much for joining us today. We appreciate it and all the information, and hope to talk with you in the future.
Thanks. Thank you so much. Thank you for the time today.
Thank you.
Thanks.
Okay, I think, yep, back down to 16 people. That's it.
So I think, Leslie, we've sort of established that it's a bit of a tight window to get into this Fund 8 close by the final close in mid-December. So I think it's perfectly fine if it's okay with the committee to continue the discussion at the next meeting and just sort of answer any follow-up questions, make sure everybody's comfortable, and see if there's appetite to move forward once they launch Fund 9, and that'll give plenty of time to look at the fund documents, put it through your legal process, etc.
Yeah, and Christian was explaining to me there is a little more paperwork in this type of an arrangement than what we've had in the past. So, we'll make sure all the documents have been reviewed through our legal staff and whatnot before we execute anything. I also want to remind the new IPS says that we can invest between 0% of our portfolio and 12.5% of our portfolio, with a target being around 7.5% of the portfolio. So I did a quick calculation on that. That's about 12.5 million. I don't think our recommendation at this point is to go all in at that kind of a dollar value, but to kind of work our way into this asset class a little bit slower. Correct, Christian? Make sure I'm saying that properly.
Yeah, that's correct. And I won't belabor this now, but I'll just quickly show. This is an analysis Joey put together, which is, to Leslie's point, you see this dotted blue line here at the top. It's a 7.5% is the long-term target that we established in the policy statement to private credit. This is a unique asset class in that it's a liquid, and the vehicle structure takes time to ramp up. So the expectation is not on day one, you're at the 7.5% target. We've done modeling that incorporates what the rest of the portfolio could do over this period. The other thing is the idea is to make multiple commitments over years to multiple series of these funds. So we thought about $8 million in the first fund you do, and do that every other year or so. And over a period of about, call it 4 or 5 years, that would get you to the 7.5% target. Part of the reason for not committing a lot more than that initially and spacing this out is that you do want that, what we call vintage year diversification. You want to be diversified by calendar year in terms of making these commitments, as opposed to, potentially investing everything right before we go into a recession. So I'm not saying it's not a call for a recession, but we know that happens in the business cycle. This is a pretty easy way to mitigate that risk and just spread it out, over time. So roughly $8 million. We could tweak that amount a little bit, but that's sort of our idea in terms of how much to commit to the first fund that you do.
Great. Any questions from the committee members for Christian or Tanya? Okay, if not, thank you so much for bringing Hamilton Lane to us and explaining all that. It's a lot of information, and like you say, we can progress into the February meeting and decide then if to take action on their next, what do they call them, series
Yep.
funds. All right. Well, if there's no other business, I do want to say goodbye to everyone. This is my last OPEB meeting. I've been with OPEB here at FCPS since day one. I was here with the first deposit when it was done in 2008, and I've loved watching this fund grow. I want to thank all the committee members who have put in their time to this committee. It takes a lot of time, not a lot of time, I shouldn't say, but it takes a lot of focus when we do work on these things, and it is the right thing to do for our retirees and our future retirees. I'm joining that rank, to guarantee that there is retirement health benefits going into our future. It also helps us from a budget perspective down the road, because we know healthcare costs continue to go up, and that there will be a point in time where we need to pull from this trust to help balance out our operating fund. And hopefully it will be a nice, healthy trust then that it will be able to sustain all those withdrawals and stay steady for us. So that is really the ultimate goal, is for our active employees and our retirees, and to help them stay with their benefits, our wonderful benefits that we have for our employees. So thank you all very much. And I'm going to keep in touch with Heather and hear what happens with this committee and the OPEB fund. I'll be very interested in watching it. So I just thank everybody and take care. Appreciate it.
Hey, Leslie.
Yes.
Leslie. I just wanted, on behalf of the board and behalf of, I've only been on this committee for a year, but I wanted to thank you for all your service, particularly to this fund and this committee, but to FCPS as a whole. So I wish you all the best, and we're going to miss you, but thank you for everything you've done.
Well, thank you. It's been an honor. It really has.
And Leslie, as one of the retirees, I definitely want to thank you.
Surely I want to have that big of a smile too after I retire. Great. Thank you so much. Yeah, definitely. Sharon said happy Thanksgiving to everyone. Hope you have a great Thanksgiving break, and take care.
Bye.
Thank you, everyone.